Welcome, everybody. So, this is a live show, and I have something awesome that we need to talk about, which is life insurance. And we're going to hear about some of the things that you think is actually good information, but is it really? So, I'm going to have the guest for the show is John Ensley. He's doing this for quite a long time, and I really think this is something that we all need to hear and learn from. So, I'll see you guys in about 2 minutes. So go ahead on and get your drinks, get settled in because we're about to start soon. All right, let's go. Welcome, everybody. So, this has been quite an adventure. I do want to hurry up and get through, but always got to make sure I get the right introduction music because we got to make sure we hype our people up before they come on the show because this is live and I can't edit this after it gets posted. So, y'all can embarrass me all you want to. All right, put y'all hands together, put y'all drinks together, make sure y'all ready for this guy. This is John. All right, here we go. What's going on, John Easley? Let's go. What's going on, John?
Hey, Anthony. It's great to be here. Looking forward to this.
Awesome. Because one of the things that, we recently had our pre-recording and you guys definitely need to stay tuned. If you're not watching this yet, please make sure that you guys are subscribed to the show on Spotify, Apple, all the fun places. Because once this episode is ready, it's going to be amazing. So, John, just tell everybody, just introduce yourself. Let us know what's happening.
Absolutely. My name is John Ensley. I'm owner and president of J. Ensley Financial. I'm a financial planning company. And my practice is focused on, I call it insurance centric. So I'm very life insurance focused in the type of planning that I do. So I love talking about particularly whole life insurance, our topic for tonight. And, I think there's so much information out there. A lot of it is good. Some of it, it's not so good. And I think, just being able to think critically and kind of sort out what's real and what's not is pretty important nowadays.
Yeah, that is so true. Especially for today. I mean, that's the reason why I asked you to be on the show because we get a lot of information about life insurance and they're always getting a bad rep. We don't know what is the true information and we just don't know where to start. So can you kind of tell us a little bit like what got you into life insurance, and then once we get that, then we can start looking at some of the things that we can debunk for the information that we hear about.
Yeah, absolutely. So, my story really starts back in the mid to late '90s. I worked for a company, and we had this employee stock ownership plan, and I was kind of in the right place at the right time. And if you anyone who remembers the late '90s, was the build up to the tech bubble was building, and this company I was with was going to do an IPO, and we were all just we're going to be rich, and it was going to be awesome. And then, of course, the bubble burst, and none of that happened. So I left there with a little bit of money in that ESOP, and I did some calculations and realized I was going to be exposed to some pretty serious taxes down the road if I didn't do something different. So real estate became my kind of my direction, and I took the money from that ESOP and I started a small subdivision, 5-lot subdivision in Washington State, and our plan was to build spec homes on each lot and sell them off. And I was about halfway through building the first spec home on the first lot in 2008. So anybody that's familiar with the 2007 through 2011 period will know kind of where this story is going. And so, I made a whole lot of mistakes for sure, but the timing and the crash and everything definitely played into it. And that whole project was not a good experience. But today I'm really grateful for that whole experience because it was a real wake up call for me. And it caused me to start learning, to start studying, to start reading. I literally read hundreds of books, and including videos and blogs and, all the online material as well. And just everything I could soak up to learn as much as I could from these not so fun events. And so in the course of all that studying, I was on a webinar one night, and this advisor was walking through this example of a couple and their home equity, and they were using this life insurance policy, and it was building up these cash values, and there was this whole strategy, and it just kind of really set me back in my chair for a minute, because at the time I hated the whole idea of life insurance, right? I had this mentality that why do I want to be worth more dead than alive? And so it was the first exposure I had to someone telling me that a life insurance policy might be something more than a death benefit, that there could be these other things I hadn't considered. And so I chased that idea and did more study, and ran across a couple of books that are out there: Becoming Your Own Banker by R. Nelson Nash, and Bank on Yourself by Pamela Yellen. And after doing a lot of study, I met with an advisor and set up these policies for myself, these cash value whole life insurance policies, and started using them. And so I got very.
Hold on. So you mean to tell me that you can use your whole life insurance like while you're alive?
Yeah, exactly. Exactly.
Okay.
And I had no idea before this, right? So once I got exposed to this idea, you can use cash value life insurance policies. Now, it's super important that they're structured correctly and that you're working with someone that knows what they're doing. But you can use the cash values in these policies to really become your own source of financing for investments or major purchases. The way I describe it is that a properly structured, high cash value, low commission, dividend paying whole life policy, you can create a system for saving, borrowing, and investing. And it's just a system that has some superior features because of the unique features of the life insurance contracts that we use. And so I got super passionate about it. And I realized that of all the financial advisors I had seen up to that point, no one had ever told me anything remotely similar to what I was learning. And so I was ready for a career change, and got licensed, completed a couple of different agent training programs, and launched my practice in 2012. So hard for me to believe it's been 11 years now that I've been doing this. I love what I do. I love helping people implement and understand this concept.
Wow. So that means that you actually know what you're talking about.
I like to think so.
So, well, one of the things is that we all have fun learning these things, and like to give a shout out to the people who are in the audience. It's my mom. Hey, mom. Thanks for coming through. And for those of you who are listening or just chiming in, We're about to do a deep dive and check out some of these stocks. I mean, not stocks. Some of these life insurance policies and information that you hear about. So who do you want to start with? Because we have quite a few people we can dive right into.
Absolutely. Why don't we start with the Dave Ramsey video?
Okay. Let's see if I can get. Hold on. Let me pause that. Get this one. Share my screen. Let's say, you guys, this is live, so sorry I could pre-record and get these going. Share screen. And for those of you who are listening on the audio side of the house, it's okay to join me on Thursdays as we get this thing going. Thursdays at 8 p.m. Eastern. All right, let me know if you can see that. Cool. So this one right here. All right, so this one right here is just the 140 mark.
Stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend as if they were a stockholder and received a dividend. Does that make sense?
Yep.
Now, follow the math here.
Oh, is that fair? Like, you can actually get dividends out of your life insurance?
Actually, that part is 100% accurate. So when in a mutual company, right, if you're using a mutual insurance company, the policy owners do have, they're sort of like part owners in the business. So in a stock company, when they perform better than expected and they pay out a dividend, it goes to shareholders, not to us, the policy owners. With a mutual company, when the company performs better than expected, they pay out a dividend to us as the policy owners. Now, when I say perform better than expected, we should put that in perspective. A lot of these companies have paid dividends to their policy owners every single year for over 100 years.
Oh, wow.
So performed better than expected every single year for well over 100 years. So it's quite a thing.
All right, let me see if I play again. I kind of moved it up so it looked like we got it like right above us.
Here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
You chuckle. Is that good?
Yeah. So I just get a kick out of this. So there's so many premises that are just inaccurate there. Number one, the assumption that the only place an insurance company gets money is from the customers. They do get premiums from their customers, but a whole component of their business, and in fact, they are regulated, that they are required to then invest those premiums to generate a return that will enable them to meet their future promises. They're very highly regulated by the state-run insurance commissioner system in what they must invest in. So the idea that somehow they charged you too much, that now they made a profit, is really not an accurate statement at all. There's a whole lot more to it than what Dave leads on here.
All right. Do you want me to keep going?
Sure.
All right. Just let me know when you need to stop anytime when I'm playing these.
Okay. Sounds good.
Cool.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so. So
Yeah. The thing I didn't love is, when you take the money back.
You can jump in here, Anthony.
Okay.
So, I love how a lot of information out there has an element or a thread of truth in it. Okay. So it is true. The IRS deems or considers dividends a return of premium. But here's the thing that actually creates a pretty significant tax advantage within the policy, because they're also not considered growth. Right. And so the other factor here too is that there's a lot of things you can do with dividends. The whole topic of dividends is I don't want to go in the weeds too much with technicalities, but there's really three categories that determine the dividend. Every company is going to be a little bit different, but it's essentially their mortality experience. So how much death benefit did the company pay out? And what that relates to is if the company is underwriting their risk appropriately. So if they are conscientious and doing their job at underwriting the business that they take on, then they should not experience an excessive mortality risk. So mortality risk, how much death benefit did they pay out, makes up a component of this dividend piece.
Okay.
The other component that comes in there is their operating costs. So the more efficiently they run the business, they will keep their operating costs low, and that's a component of this dividend piece. And then the third and final component is their investment experience. So the returns that they get on that general portfolio that they're experiencing. So those three components really make up the scale or the amount that the company will put out there in a dividend. Now, because it's based on performance, right? Each of those three categories every year is going to be different, right? So dividends are not guaranteed in the policy. Because they're declared year by year by year based on the performance of that year. But again, I'll go back. There a lot of companies out there, mutual companies, that have paid these dividends. So in other words, they've controlled those three components of their business very, very well every single year for over 100 years.
Okay, so that means that they're going to be around for quite some time.
Because that's the idea, right? You want to work with a company that you know is going to be there for your life, your kids' life, your grandkids' life, and on and on.
Perfect. All right. Do you want to hop to the next one or keep going? I think
so. Dave kind of goes on a rant here, but it's mostly the same thing. Oh, there is another part. Yeah, let's keep going. There's one more thing I really got to point out because it's a pretty common misconception.
All right.
We are paying an interest rate on it.
Exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep.
This is infinite banking for them.
Yeah.
Yeah. The infinite banking concept is old school, whole life, done poorly. You need a real financial advisor, not an insurance broker that's trying to sell you a load of manure. And so, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put in.
Okay. So there's a few things there. And this is one of the most common things you hear out there from detractors of whole life insurance is that your cash values die with you, that somehow you lose the cash value in the policy when you die and the death benefit pays out. And what this really comes from is folks that say this just completely don't understand how whole life insurance works. So we tend to think about a whole life policy as having a cash value and a death benefit, and we think about that like two separate things. But in reality, they're not two separate things. They are all one thing. And so the way I describe this is if every dollar you put into a life insurance policy is buying death benefit, it's life insurance, right? We're buying death benefit. Certain types of death benefit, and I'm not going to get lost in the weeds with technicalities, but certain types of death benefit will produce, let's say, cash value at different levels. And so when we talk about structuring policies, this is what we're talking about, is within the guidelines the IRS has established, we're designing these policies to buy death benefit that produces cash value at an accelerated rate. And so the cash value and the death benefit are really one and the same thing. The cash value is really a byproduct of the death benefit. The death benefit is that thing, that benefit that you get when you die, that your beneficiaries, your heirs get. The cash value is like that thing. That cash value is that thing that's the benefit that we can use while we're still alive. We have this cash value in the policy. And so they're really not two different things. You could also say that the cash value is really already contained within the death benefit, right? Because they're one thing. So your cash values do not die with you. It's not like there's this bucket of cash value that the insurance company just keeps when you die. They, in the way I design policies, the death benefit is always greater than the cash value, right? So the cash value, when the death benefit pays out, it's paying out more than the cash value is in the first place. And it's all kind of one thing. Does that make sense? So it's not this separate bucket that we lose. It's all already contained there. We're definitely, getting the benefit out of the policy while we're alive and then after we die.
So it's almost like it's almost like a win-win situation. It sounds like to me.
Yeah, exactly. But a lot of detractors of whole life insurance like to make that comment that your cash values die with you, which of course is not the case.
Now, one thing he did say was talking about infinite banking.
Mm-hmm.
Like, is that something that is really a good term to use, infinite banking, or is just as much money as possible inside your policy, not so much infinite?
So I think infinite banking, that kind of came from Nelson Nash and becoming your own banker and so forth. It became a term that was kind of coined. It's a marketing term, right? So you have to call it something. Whole life insurance has been around for like 160 years, right? It's nothing new, but marketers have had to call it something. And so you'll hear it called infinite banking, bank on yourself, cash flow banking, leap. It's been called a lot of different things over the years, but it's really describing using whole life insurance contracts as a wealth building platform. That's really what it's about. Right. The other thing too with infinite banking is I think if you look at uses, if you have a policy, you have cash value, there's so many ways you could use it. And I think that's kind of the origin of the infinite idea is you can use this in infinite ways. Okay.
Then I'll have to look into that a little bit more. Well, thank you for doing that. So
absolutely,
I skipped through a little bit further in to the 640 mark, talking about Xander Insurance. So see what he has to say about that.
Like a Xander Insurance, and you get quoted on term life insurance, you're going to find no mutual companies in the 42 different companies that they give you a quote from because they're not competitive.
That's it.
Why? Because they charge more so they can give some of it to you back later and make you feel like that you got something. That's really what it amounts to. And that's why you won't find them. They're not competitive.
Yeah. Dave, you fired up about this one.
Man, I tell you what, pisses me off. Infinite banking my butt.
Okay, Dave.
Infinite.
All right. So, I guess I should say that there's a whole lot that Dave Ramsey puts out that I think is fantastic, right? Live below your means, get out of debt, stay out of debt, make your money work for you, right? All of this stuff you can't argue with it, right? It's fantastic. Right. And for whatever reason, he's got this, I don't know, mental block about life insurance and in particular the whole life insurance. So the Xander Insurance thing is interesting because that's the only company Dave ever mentions in regards to term insurance. He's a buy term and invest the difference kind of guy. And there's another video, we'll talk a little more about that concept. But, and so, the note I made to myself was, this is what Dave is selling, right? So I always watch for in these types of videos or marketing material, right? There's the whole approach in marketing where you kill your competition.
Yep.
I remember when many years ago, I worked just briefly as a vacuum salesman, right? And
which vacuum were you selling?
Filter Queens.
Oh, I haven't heard of that one.
Yeah, that's because it was a long time ago.
The Kirby's still around, so that's what I was wondering.
Yeah, the curb, you bet. And so there was I can't remember the name of it now. There's another one that has water. The Filter Queen works with a paper filter. And there's another one you put water in. And I remember I went to my first week of training, and the guy brought this other vacuum out, and he's like, "We have to kill this machine," and so he just, everything that was wrong with it. And that's, sometimes that's the way marketing works, is that people, in order to sell their thing, they've got to bash the other thing. And that's what happens here a lot. You know, Dave has products and services that he sells. He's got relationships with companies that he wants to support. He's been saying these things for a long time, so he can't really change his tune now without losing credibility. So you know, that's kind of, I always look for that. What are they selling, right? What's the alternative they're trying to push us towards, and do that. You know, I like to share a story quite often about Thomas Edison. Thomas Edison, inventor of the light bulb, American hero, right? All of that. In 1903, Thomas Edison on camera was electrocuting a live elephant. It's a really bizarre thing for someone to do, right?
Yeah, especially on TV.
Yeah, exactly. So why would he do that? Well, he and a guy named Nikola Tesla were competing on whose system. Edison was direct electricity. Tesla was alternating current electricity. Whose system was going to go into the Niagara power plant? So Edison was it's just a marketing stunt. He was trying to get people to believe that AC electricity was too dangerous to use so that he could sell his system, the DC power system, into the power plant. Now, is that true? There's again a thread of truth. If you grab a couple of wires out of the socket in your house, yeah, you're going to find out it's pretty dangerous. Right. But the whole world runs on AC power today. So he didn't win that marketing battle, but it's a good example of what happens, right? They're just marketing messages. And I think we have to sort through the marketing messages and actually do some critical thinking and some analysis to decide what's a good fit for us.
And that's the reason why, like, I started this show, was to kind of help include that critical thinking, and that we need that piece inside our knowledge, because we got to see through the BS that's out there.
Yes.
So speaking of some BS, what's the next one we're going to look at?
Let's go to the Wealth Nation.
Wealth Nation. Alrighty.
There's a couple of things in there. Okay. And I want to start out by saying that, you know, the folks over at Wealth Nation, actually, a lot of their material is pretty good.
Really?
You know, they do a pretty decent job with a lot of the things that they cover. I think they have a fairly good understanding of the concept, but there were a couple of things that were just so glaringly wrong that I kind of had to put them in here, right?
Yep. All right. So this one is about the 4% guaranteed.
Yeah.
All right. Let's play.
Of your contract through the life insurance company. Insurance policy. Next is the guarantees that are provided inside of your contract through the life insurance company. Our policies currently grow at a guaranteed 4% compounded rate at the time of us signing our contract, because that is how the life insurance policy.
There. This is, I see this so often, this idea that a whole life insurance policy has a guaranteed compounded return of 4%. And it's just completely, absolutely not the case. So here's what happens. And again, it's kind of a lack of understanding of how things work. And what happens is in a whole life insurance illustration, which is a document that you get from an agent or an insurance company that outlines all the numbers and everything in the policy, there's a section in there on costing. And there is some NAIC, National Associations of Insurance Commissioner language that is required to go in there. And it talks about the costing being based on a 4% interest rate. And so that statement
in NAIC,
National Association of Insurance Commissioners.
I just want to pull that up right quick. So since we're doing it here, like, why not?
And so that the language in that illustration that talks about 4% has absolutely nothing to do with your specific policy or the cash values in that illustration. It is simply a guideline for how an insurance company does the costing side of the whole thing. It really has no relevance. And I see this all the time where agents mistakenly take that statement and then say that I'm getting a 4% guaranteed compounded rate of return. It's just absolutely false. There is no such thing as a guaranteed compounded interest rate in a whole life policy. It's an actuarial product. It doesn't work that way.
Gotcha. Keep going.
Yeah.
All right. Cool.
Oh, actually, we can move to the next video on that one, because I think this was two separate ones.
Yep. Let me go down. Wealth Nation, 1150. For Wealth Nation, you only
Yeah,
gave
it
me
should have
one.
been.
You only gave me one for Wealth Nation.
Oh, I thought there were two.
Unless the very beginning, because you gave me the timestamp for the 4%.
And then paying yourself extra interest.
Oh, it's another one. Sorry, I see that. Sorry about that.
No problem.
That on this tab. Okay. There we go. That'll explain why I couldn't find that 11. Where's that? All right.
Conversation, we also asked what is the average interest rate that clients do have when they come and finance through your company. What is the worst interest rate, or for us is the best interest rate, is their worst? What is the worst interest rate that people have? And they gave us an average. And what we said is, okay, we'll come in the middle of that and we'll charge ourselves 10%. Mm-hmm. Now, 10% for a car loan is a lot, but when the company in which you're financing it through is your own, then that changes the conversation a little bit, because not only are we, making payments on this car, we also are making payments on this car with the intention of making a future car payment.
Yeah.
Right?
Yeah, because the whole point of borrowing from your policy is if you're going to borrow from your policy for infinite banking, now the money is outside of the policy. This is infinite banking, right? So what are you doing with these funds to make money? Mm-hmm. We know that we got to charge ourselves more than 5%, because that's what it.
Okay.
So this whole concept, when you start talking about infinite banking, comes up a lot, where you can pay yourself back the interest, right? I talk to folks all the time that have heard something on the internet, and they end up getting a hold of me and they say, oh, this is great, I can pay myself back the interest. Well, it just doesn't work that way. So not that policy loans aren't a powerful tool, they are, right? You can use policy loans with whole life to make major purchases and make investments. It's at very, very low rates, the way it works out. And it's a very powerful way to do things, because what happens with a whole life policy loan is, let's say you borrow money out of the policy, you've got 50,000 in there and you borrow 40 of it out to go buy a car or whatever the case may be. And then you pay yourself back like they're describing, right? You pay yourself back to the policy a certain amount until that's paid off. And while that's happening in the background, your policy values, your cash values, and your death benefits and so forth are continuing to grow at the same pace they would have had you not borrowed it.
Got you.
So there's a double.
It just doesn't. It's weird. Okay.
Yeah, it's so there's two sides to the coin, right? On one side of the coin, I can borrow money against my policy, and that's what's happening. You're borrowing against a policy. You're not borrowing from your policy. So the insurance company is essentially using your policy as collateral. The limit of what they will loan you is the amount of cash value in your policy, and the collateral is the actual death benefit. And so because of that, it's a non-recourse loan, right? That means the only thing collateralized is the policy itself. You can pay it back on any terms you want to. You're in control. There are a number of benefits. So it's a very powerful tool to use. But where we go off the rails is when we start saying that we can pay ourselves extra interest, because that's really just a play on words. So if I've borrowed the money from the policy, and like they said, I'm going to pay myself back 10%. Right. And so you calculate a payment at 10% and you pay it back. All that's happening there is that you're paying the loan down faster. Okay. And when the policy loan's paid off,
you get the
then you're just putting extra money in the policy. But you can call it whatever you want to call it, but it's just paying more into the policy, which is a good thing to do. So I'm not criticizing the idea that putting more money in the policy is good. I just think it's misleading to let people think that they're paying themselves extra interest, right? Because they're that extra interest, quote unquote, is just more money that they're taking out of their bank account and putting in their policy. So I think it's super important to be transparent and clear. I don't want anyone to think you can just pay yourself 10% interest as if that's some magical formula to make more money, because it's coming out of your pocket. You're
Right.
putting it in the policy, which is a great thing to do. Absolutely. Let's put all the money we can in our policy. But it's not paying yourself extra interest. That it doesn't work that way.
Got you. And it's almost like your credit cards. I always laugh at that as well. It's like, even if you paid the money, just pay it off. Like if you have the means to pay it off.
Right.
Is there more from this one, or you want to move to the next one?
Now we can move to the next one.
Okay. What, invest with Wesley, or you do bigger pockets?
Let's do bigger pockets. There's a lot on that one.
I was like, man, you put me to work on this one. Okay. Let's see. Bigger pockets. Okay, we're just gonna do this one starting off at dying at 92. Pause it here. Because Bigger Pockets Money, I actually do enjoy that podcast. They always have some really good insight.
We should say in almost all of these, right, that none of these are bad people. I don't believe they have any malicious intent, that kind of thing. I just think there's some misinformation and so forth. I mean, there's good information on all these shows, I'm sure.
If they're married or have kids or whatever, that lasts a few decades. And they should insure very well during those few decades. I'm talking 7 figures of insurance. Most people should carry 7 figures of life insurance. And that's not that expensive if you buy it when you're young and healthy.
7 figures is quite a bit. Is he talking about as far as term, I assume?
So this gentleman is known as the white coat investor. He's the guest on Bigger Pockets, and he is a famously buy term and invest the difference guy. He's very against whole life insurance, and there's just again, kind of like with Dave Ramsey, there's just kind of this lack of understanding, I think, of how it works, or maybe not open-minded to see that there are ways that this works that are a little different than the way Mr. Dale describes it.
All righty. And just let me know, as usual, just let me know when I can stop.
Okay.
$600 or $700 a year is all it costs to have $1 million in term life insurance. But what is not a financial catastrophe for most people is dying at age 92. That's just not a financial catastrophe. It's an expected event, right? We all expect that to happen. Presumably, no one is depending on your income when you're 92. So do you need insurance when you're 92? No. And should you
All right,
buy
let's pause right there.
He's killing me.
So I know it's hilarious. And again, it's a pretty common thing out there to say that when you're old, you don't need insurance.
Right.
And that is, I mean, it may be true in some cases, but in most cases, that insurance benefit can have multiple uses, whether it's estate planning where they factor that in, or there's a number of different things. So the idea that life insurance is only for catastrophes, right? When you're young and earning money, that it's this catastrophe thing is I find just ludicrous.
Right. This guy's great. Keep going.
Yeah, let's keep rolling.
All right.
Insurance that you don't need? Generally, no, you should not. You should insure well against financial catastrophes, but you don't need to insure your iPhone falling in the toilet, right? You can afford to replace that. And what whole life insurance is a lifelong insurance policy. So whenever you die, whether you die at 25 or 45 or 70 or 92, it is going to pay you, or you pay your heirs, really, pay your estate, but it's going to pay out a death benefit. And of course, if you want something that's going to pay out no matter when you die, that's going to cost a lot more than something that's only going to pay out if you die between age 30 and age 55 or 60, or whenever you become financially independent. And so naturally, you would expect whole life insurance to cost a lot more than term life insurance, and indeed it does, depending on your age and health status and that sort of thing. It's typical to pay 8 or 10 times or 20 times as much for the same death benefit. If you die at 55 and you got $1 million in term insurance, you get $1 million. If you die at 55 and you got $1 million in whole life insurance, you get $1 million. That's it. It's the same death benefit. And so that is the overview of whole life insurance. And people think about it that way. And that's the way most of them should think about it. You go, of course I don't need to have insurance after I'm 60.
Yep. So a couple of things that just jumped out there that I want to mention. So first of all, term insurance, it serves a purpose, right? For sure, it serves a purpose. But you always have to remember that it's very unlikely that death benefit's going to pay out. It's kind of like your car insurance. Pretty unlikely you're going to get in a wreck, right? But you're going to pay for it anyway. But it's a pure expense, right? That premium is a cost. It goes out the window and never to be seen again, right? Unless you die.
Yep.
Okay. You can't really even compare whole life. So this idea that you can compare $1 million of whole life and $1 million to term and somehow make a cost comparison is ridiculous. $1 million in whole life insurance is gonna be throwing off cash value, number one. So there's a living benefit to that policy. Number two, it's going to cover you no matter how long you live. The term insurance is going to run out, and then it's going to be exponentially more expensive to renew.
Yes.
At your older age, right? And then this is what happens. People get into their 70s, they can't afford it anymore. And I work with people all the time that are in retirement or approaching retirement, and they suddenly realize that if I die, my spouse's income is going to decline. They're going to lose part of their Social Security. They might have a pension that's going to stop because they didn't set it up as a joint pension, right? There's all kinds of reasons. And now they want to get life insurance, and they're in their 70s, and term insurance is enormously expensive at that point. So if you're young still, or young-ish, right, and not in your 70s, whole life is a fantastic tool to be able to provide that kind of protection without that term coming to an end at some point and all your premium just being gone. Poof. It's just a pure expense that the insurance company got. Whole life has a value. It's going to build up. And if it's designed right, you're going to recover the amount of premium you put in the policy in a fairly short period of time, so that the cash value in the policy exceeds all the premium you paid.
And that's usually about like 10 years, right? Roughly about
10 years or less, depending on the structure.
Okay. That sounds good. And I like people love these controversial side of the house. It's like, this is my stance and this is the only way I see life. And it's like, well, if you're young, you're 20 something, who's running out there getting a 60-year or a 70-year term policy at $1 million plus? Because if he's talking about 92, that's assuming most people usually only get like a 10-year policy, because it's like,
and you usually really can't even find more than a 30-year. There might be a couple of companies out there that offer something longer than that, but typically 30 years is as long as you can go.
Okay, so then what does this guy tell? So pretty much you're going out there every 30 years getting a new policy. So would it make sense for them to go get like a hybrid?
Well, what makes sense to me is that they would get a properly structured whole life policy that'll cover them forever, and give them some living benefits along the way that are pretty powerful too.
Let's see, we're going to skip around on here. What's the next part do you want to jump to?
Let's see. So he talks about commissions here at 1235.
All right. Oh, they already got a cut. Sweet.
Broad overview.
So Jim, why is whole life insurance sold so hard? Why are there so many proponents that are so hardcore about this product?
Well, you'll find that 95% or more of the proponents, it might be 99% of the proponents, sell it for a living. Okay, so there's this huge conflict of interest.
Is this a lucrative way to make a living?
People may not realize how lucrative it is. The typical commission on selling a whole life policy ranges from about 50% to 110% of the first year's premium. So if your premium for this policy,
is that true?
So there's again a thread of truth to it, but it's not quite accurate. So a whole life policy, again, properly structured is really the key here. Someone that knows how to structure a policy for cash value accumulation, it actually is cutting about 70% of the commission out of that policy. Which is, of course, flowing into you, the policy owner's policy, in that way. So the other thing, too, I love this whole thing with commissions are a conflict of interest. This comes up quite a bit. And this is the most ridiculous argument to me on the whole thing. So there are advisors that charge at a percentage of assets under management, right? You can place your money with them, they'll invest it in the market, and you pay them an annual 1% or 2% or whatever that figure is. They range from 0.5% to probably 4%, depending on what you're doing. There are fee-only planners that will charge you to put together a financial plan, and then usually some ongoing type of charge, $100 a month, something like that, or an annual fee to help you manage it. Okay. And fee-only is pitched as, right, it's unbiased. It's unbiased advice if they're charging you a fee only. Because they're not getting a commission and they're not getting a percentage. But the reality is these are all financial professionals. None of them are going to do what they do for free. Everybody knows that, and nobody expects them to, right? Yep. So the idea that because one type of financial professional is compensated by an insurance company in the form of commission, and another type of financial professional is compensated by taking a percentage of your portfolio, and another is compensated by you just paying them a fee, it's all really the same thing, right? They're performing a service, they do what they do, and it's just, this is how they get paid for it.
Right. It's like, why would you be doing this for free? Like,
yeah, exactly. And so they kind of make this argument that somehow insurance agents are, and you know, every industry has unscrupulous people. Every industry has dishonest people. Insurance, financial planning, right? There are great advisors and there are terrible advisors, and that's the reality in every industry, right? Yeah. So I'm not saying there aren't people out there that are unscrupulous and are gouging their customers, et cetera. That certainly happens. But I think the vast majority do a really good job. They put their customers' interests first, and they're just trying to put the best solution they can together for that person to reach their goals. So what's interesting to me is if you just run the numbers, you know, if you pay somebody a fee, say $3,000 to build you a financial plan, and then you pay them $100 a month, which is $1,200 a year, right? Yeah. So over 25 years, you're going to pay that advisor over 30 grand.
Right.
Right. If you've got assets under management, and that's a lot of money.
Yeah,
for sure. If you've got assets under management, I have this whole thing that I run through where if you had $500,000 and it grew at 3% a year over 25 years at a 1% fee, in the 25th year, you will have paid a cumulative $182,000 in fees, right? Yeah. That's a huge amount of money.
Yeah.
And so if you look at the commissions that insurance agents make and you actually calculate it out, you'll find it's going to be very comparable to the fee option. It's nowhere near the percent of assets option, much lower, but they're all pretty comparable. And so it's just a ridiculous idea to me that we have such a argument about there being somehow a conflict of interest because there's a commission on an insurance product as opposed to a percent of assets under management. It's just the fee for the service that gets provided, and it is what it is.
Gotcha. So do you want to move on to the next part of this one where it talks about the insurance is a bet? You know, I'm going to take a quick pause before we get to the next one. I just want to let everybody know I actually got selected to be a speaker at FinCon this year. Isn't that amazing?
Awesome?
Yeah, I'm so excited because this is my very first speaking engagement. Thank you. So the cool thing about it is, like, you know, if you scroll down, you can see they like to call the cool speakers. Some of these people actually have been on my show, so you might be surprised to see them. But hey, look, it's me. Yay, look. Let's see this.
That's awesome. Congratulations.
Yeah. So if you guys want to be part of FinCon this coming year, you can actually go to finconexpo.com, and when you go select to checkout, they actually ask you for a particular promo code. You just have to put in about that wallet, and once you do that, you actually save 10%. So because you save 10%, hey, you get to save 10%. You get to see me speak and see so many awesome financial people talk on the show. So I had Rakim Sabri on the show. He's been on there, so he'll be talking this year. Matt Disley. So all these people here, these are from last year's stuff, but I just wanted to share that with everybody. So excited.
You should be. It's exciting.
Very first gig. I'm so excited. So we want to talk about the insurance is a bad deal breakdown. So let's see what we got. 15, 30.
If it's a for-profit insurance company, so it's going to take a little bit of profit. And then, of course, it's got to pay any claims that come out, all out of that premium. So on average, insurance is a losing proposition. On average, you will always come out behind buying insurance. Now, I'm not saying don't buy insurance when you need it, but recognize that it's a bad deal for you. And so you shouldn't buy any more than you need. And indeed, I think if the plan, let's say you're married and the plan is for your spouse not to have to work if you die, if you get hit by a bus tomorrow. If that's the plan, then yes, that term life insurance policy needs to be large enough that they become instantly financially independent when you die, and they can live off the combination of what you've already saved plus, the life insurance proceeds for the rest of their life, if that's your goal. But do you have to absolutely replace every dollar you ever earn from here on out? No, you don't have to do that. You just got to look at what your needs are and buy enough insurance to cover those.
As we were preparing this show, my producer, Kaylin, said, I don't understand the purpose of this product. Who is whole life insurance for, and who doesn't benefit from it?
Okay, well,
you can pause there.
Yeah, because Randy Jensen will be at the FinCon this year, I believe, if I'm not mistaken.
Mr. Dale will?
No, Mindy Jensen.
Oh, from the Deeper Pocket or Bigger Pockets.
Yep.
Yeah, awesome. Cool. So the main thing there was that he talks about how the premium has to do all these different things. And again, kind of like Dave Ramsey did, they're completely discounting the whole investment portfolio of the insurance company and the revenue that they generate that way. So it's just kind of an erroneous thing that the only money an insurance company has are premiums. Certainly that's a portion of it, but I don't think it's a bad deal when these companies have been operating successfully for 110, 120, 130 years. They're doing something right.
Yeah. So, and it also gets to think of, is it possible to see what they're investing in, which I think is interesting to see.
Most of the companies actually publish not their specific investments, but they'll publish what percent is in corporate bonds, what percent is in mortgages, what percent, et cetera. So usually if you're a policy owner, you're an agent, you have access to the information to kind of see what they're doing.
All right. So, because I know we got a couple more to go through, but I do want to open it up the phone line. So if anybody do want to give me a call to have any questions right here live about life insurance policies, please go ahead on and give us a call at 833-699-2558, and you'll be live on the show. But as we go through, let's see what else we got going on. What you want us to keep going, or the next part in this?
Yeah, let's see. Let's go. We already talked about commissions.
Paying for college, or you want to do the fiduciary?
Let's go to the fiduciary, CFP, and commissions. Although, yeah,
we kind of talked about that.
Yeah. How about paying for college? Jump to that.
Okay. Because this one, I think I'll be pretty much be shaking my head the whole time if I were to watch this.
You can get. Okay, another use case that people will sell you on, which I think is one of the dumbest ones, is to pay for college. I mean, most of these policies out there don't break even for 15 years. You know, that's just getting back to the total of your premiums paid. And so they're like, oh yeah, buy this and you can borrow against it for college. And, you know, it's great. Well, it's not great. You know, you break even after 15 years. That's when you need the money. It hasn't grown. You basically had to save up everything for college. Your money didn't do any of the heavy lifting. You're far better off buying a rental property and using the income from that to pay for college, or selling it and using the proceeds to pay for college, or using a 529 account to pay for college, you know, where you actually expect the investment to grow as you go along, than you are buying a whole life insurance policy to pay for college. So that's one of my particular pet peeves. I think it's
there.
Yeah.
So he goes on a rant there about paying for college using a life insurance policy, and it's actually a fantastic strategy as a college savings plan to use properly structured whole life to accomplish that goal. And the reason being is there's so many different things you could do with it. He mentions 529 plans. 529 plans pigeonhole people terribly because it can only be used for college. And, you know, a few rules recently changed that make it a little better where you can maybe move it over to a sibling or something. But mostly it's, you know, what if Johnny doesn't go to college, right? And now you've got to figure out what to do with this money without taking a tax hit. Those kinds of things. And then there's this underlying thing that he does there that a lot of these buy term and invest the difference guys do. And that is they allude to the fact that the 529 is going to grow.
Yep.
Right. And so this whole idea that the market returns some X percentage. And most of the time our impression of that is far different than the reality of it. So average rates of return, for instance, is what all of this is based on. And there's this little exercise that I do where, Anthony, if you were the advisor and I gave you $10,000 because you convinced me you could grow my money, and you double my money this year, right? You get me a 100% return and you grow my money to 20,000. Well, next year, unfortunately, Anthony, you didn't do so good and you lost half my money. You get me a negative 50% return. Okay. Over the 2 years. And so I had 10, I grew it to 20, I lost half, I'm back to 10, right? If I do just averages, math, I go 100 minus 50 is 50 divided by 2 years. That's a 25% average rate of return.
Right.
Should I be happy with you? You got me a 25% rate of return.
Yeah, that should be. Yeah, you should be, because the normal rate right now that everybody kind of use the baseline is the S&P 500 rate, which is at 8%. So 25% sounds a lot better.
Sounds awesome, right? Except one problem, of course, I don't have any more money than I started with 2 years ago. Right. And so this is the misconception that's out there, is that the S&P 500, for instance, returned 9% over the last 30 years, or, you know, the number updates all the time. But so when you hear that figure, that doesn't mean that your dollar in the S&P 500 30 years ago will be worth a compounded 9% per year return today. That's not what it means at all. It just means that the average of the ups and downs in the S&P 500 index average out to 9%. It has nothing to do with your money. You can actually have been in that market for 30 years and have no more than you started with, or very little more than you started with. There's a company called Dalbar, and they do independent research, and they publish every single year since the late 90s an analysis of investor behavior. And so they give us some statistics every year. And the 2022 report says that the average mutual fund investor is getting about 4%, a little over 4%. The average income investor is actually losing ground, and the average asset allocation investor is at 0 over 30 years, right? Wow. So that's what real people are actually getting. And so this whole idea to buy term and invest the difference is based on this idea that somehow we're going to get 9%.
Right. But also, how much are you really investing?
Exactly.
Right. Because are you talking about like, hey, I only can put off like $10 to $20, or maybe $200 a month, and some people only have like just maybe $5. So what do we do?
Yeah. It's and I think we have to start by being clear in our expectations and understanding that when we see some of these things, they're somewhat misleading.
Right. And you gotta love these because it's just the information itself. It sounds nice percentage wise, but when you actually look at the dollars, it's not that much.
Yeah, exactly.
And you know, most of us will try to touch the money if we could see it growing. It was like, hey, we're gonna get out the market because it's going down. So, you know, why not just keep it in the whole life?
That's my philosophy.
Okay. All right. So we actually at the top of the hour. Do you want to do one more or just kind of close out? How you feeling?
Yeah, we can do one more if you want to keep it rolling. Let's go check Doug Andrew out.
Alrighty. Let me pull Doug Andrews video. How you guys doing out there in the audience right now? Just curious, just kind of get a pulse, see what you guys are at. Are y'all still alive? Are y'all with me? If y'all have any questions, please go ahead on and drop them in the chat. I know there's a delay from the live versus, you know, it takes time out to shop, you know, to type out everything, but we'll be here to listen. Okay, share the stream. Bring it on over. Cool. Okay. With this, we want to start at 310, talking about the 4% to 2% leverage. Or did you have some place you want to start?
Yeah, we can start there.
Okay. 310.
80s was built on a chassis that was based upon a 4% guaranteed fixed interest rate.
See, there's that again.
Life has merits because it's structured to be able to give those guarantees. But in a low interest environment like we have been in recently, where a lot of banks and so forth and the Fed rates and the US treasuries are under 1%, how are insurance companies going to continue to be able to cover you for your whole life based upon 4% when they're not able to earn 4% maybe? This is putting insurance companies into a bind. And so that's why in the wee hours of the very end of the year 2020, Congress passed, as part of that big stimulus legislation, changes to Section 7702 of the Internal Revenue Code. I have other episodes I'm going to be releasing that explain this, but that is going to take the guarantee down to 2%.
All right, we can pause it right there.
Inside of whole life.
Okay.
So the whole premise here, again, that 4% guarantee is completely erroneous. There is no guaranteed interest rate in a whole life policy. So you can call it 4% or 2% or whatever you want to call it, but it has nothing to do with how your cash values and so forth are accumulating. It just doesn't work that way. So this whole idea that how are insurance companies going to cover it because they can't earn 4%? It's just a logical fallacy from top to bottom, right? Because the 4% is not a rate of return in the policy. It has to do with the costing regulations and so forth and guidelines.
Yep. So this is the reason why I had you on the show, because we explained all this stuff in the beginning, so that we hear all these people. It's like, man, we know this guy's lying over here. So it's great. We do have a question in the audience. So my mom asks, I often hear about people cashing in the whole life insurance. Do you think this is wise?
So I'm assuming, Devana, that what you're referring to is someone canceling or surrendering a policy and walking away from it. And so typically, no, that's probably not wise, although there are good reasons to do that. So every individual circumstance would really, depend on the circumstances there as to whether it was wise or not. But typically you've got this policy, once it's issued, covers you for your whole life. And no matter what else happens to you, right? 10 years in, you could get cancer. You're still covered, right? So it covers you for your entire life. And then also the way the accumulation works is it's cumulative. It builds on itself. And so one of the ways I describe this is a whole life policy is going to grow by a larger amount every year as long as you live, whether you like it or not, and there's nothing you can do about it. And so after a period of time, it would really be foolish to just cash that policy in once you've got that momentum building within those cash values and death benefits that are building up. So I would say typically, yes, it is unwise, but that totally depends on the circumstances. There are a few good reasons that you might do that.
Awesome. All right. Hopefully that answered your question. So let's get back to this guy.
Yes.
All right. Do you want to jump to one last one?
Yeah, let's go down to 1044.
Okay. I was looking at 555. I was like, oh.
Well, there's that one too. Either one.
Because that one is, all right, yeah, let's go with 55. Because that one intrigues me.
Okay. Yeah.
Which is, for those of you who are listening, this is talking about how going to grow to $1 million, the cheapest life insurance policy you'll ever see. And I had to say that's pretty interesting. I'm gonna go like a second before.
Policy is within 5% of the death benefit within 15 years. So the cost of the insurance is next to nothing. In other words, if you put in $500,000 and the amount of insurance required for it to be tax-free for a 60-year-old was $1,250,000, that $500,000 has grown to $1 million within 7 to 10 years. And in another 7 to 10 years, it's going to grow to $2 million. Well, that's more than the insurance. So the insurance stays ahead of it by 5 percentage points. Indexed universal life is by far the cheapest insurance policy when it's structured properly you will ever see, because it gets cheaper as you get older. You don't need guarantee.
This guy's
this is so I'm going to go on a little rant of my own here. So he's referring to to index universal life insurance, and so much of what he says there is just so off base in terms of inaccurate. So number one, index universal life is a term insurance policy with a side fund attached. You overfund the policy and they credit you some interest based on a stock market index in the side fund. The idea, we talked about average rates of return a moment ago, and this is a problem with index universal life, is that the rate of return that they project in their illustrations is based on kind of that scenario we just walked through, where they're saying the market returned in the last 25 years 8%. So they project 8% forward in the future. And that's how he's saying it's going to grow to another million in 7 to 10 years. It's based on the idea that they're going to be these average rates of return that come into the policy. And that's just completely erroneous. It's never going to happen. So the idea that it's the cheapest kind of insurance is just outright wrong. Annual renewable term, which is the chassis that IUL is built on, is actually probably one of the most expensive forms of life insurance that you can buy. And the cost of that gets more and more and more and more every year. So he says it gets cheaper as you get older, which is absolutely not the case. That term insurance is going to have to renew every year. And when you get up into your 70s, mid 70s, early 80s, those costs, the cost of insurance built into an index universal life policy, are absolutely astronomical. You've seen so many of these that have blown up, where the cash value gets consumed by the increasing costs so quickly, and then people get a call or a letter saying that they have to put thousands of dollars into the policy to keep it from lapsing. So I just can't say enough. I think this is index universal life in the vast majority of situations is probably just a terrible option in so many ways. So I can't say enough about it. I think stay away from index universal life for the most part. I'm sure there's a case use out there where it might work, but 99%, I think you just stay away from it. There's so many problems.
All right. So you say to stay away. You already bashed it. So, like how they say, we already talked about the marketing. Well, we're going.
That's true. It's true. Although, you know, if you sit down with me for a few minutes, I could take an illustration and show you exactly why. I'm licensed to sell index universal life. I contracted with carriers that offer index universal life. I will not present it to a client. I've seen too many examples where I don't ever, as an advisor, want to be in a situation where I have to look across the table at a client and explain why this blew up, why they lost money, why, right? I don't ever want to be in that position. That's just not the way I do business.
Now, here it's almost like the Baskin Robbins when it comes to life insurance. So you said no IUL, but also obviously it all depends on what type of life you want to live, which determines what type of life insurance you decide to get. So obviously, as you guys listening to the show, this obviously is for education purposes only. So don't try to sue any of us about this information. We just say that you talk to your proper financial advisor or whoever you listen to for financial advice. But with that being said, I know we're at the top of the hour. So John, I just want you to take it away. Just tell everybody, just leave them with something that they can take action on today, and then also tell them where they can find and meet you.
Absolutely. So I think the things that you can do to take action today are get some education, right? There's books out there. The two of them that I mentioned, Becoming Your Own Banker and Pamela Yellen's The Bank on Yourself Revolution. Those are great books to give you a kind of a 10,000 foot view and education on how whole life insurance can be used. And you can reach me if you'd like to find out whether this is a good tool for you. If any of this intrigues you, I've got a landing page set up that's jumponwithjohn.com. And you can schedule right in my calendar and grab a free strategy session. And we can just talk about your specific circumstance and how this tool works. I'm not a believer in selling anyone on the concepts that I work with. I just educate. And if it's a good fit, then you'll raise your hand and ask for more help. So you can book something with me at jumponwithjohn.com, and I would love to chat with you.
All right, John. Thank you so much for coming on the show. For those of you who are watching this live right now, or watching this on Spotify, you can actually see his website. He has a 1, 2, 3 punch. Pretty much you enter the information above, you set up the schedule, and you meet John. So you can go ahead on and knock that out today. Oh, man. Hopefully you guys got a lot of information out this episode. I greatly appreciate you, John, for coming through, because some of this information, like I had so many other life insurance people come on the show to talk about life insurance. But I think this was the first one I've ever done with a debunk the information, and I had an awesome time.
Yeah, it was fun. Thanks for having me, Anthony. It was awesome.
No problem. If you can just hold on for a second, I'm going to play my outro, and then we'll talk behind the scenes.
Okay, sounds good.
All right, cool. All right, everybody. Y'all be safe. I'm out.